I saw a really interesting stat. And when May, the market goes up over 5%, which it did this past May, 100% of the time, the market's up the next 12 months. And on average, it's something like 20%. So if you do the math on that, the S&P 500 is going to 7,000. So tell me it's true, Courtney. Is that where this market's going?
And there's an old saying, you want to sell in May and go away. And clearly this year, that was not true. Actually, a lot of your return recovered after Liberation Day here in May, which is also why you don't want to try to time the markets. You need to stay invested because, yes, most of the largest up days in the market happen within a month of your down days, and you never know when that's going to happen. This is why you need to have a strategy to stick to your strategy and absolutely stay invested. But I mean, we're definitely hopeful here that markets are going to go higher.
I think the most confusing advice I've been giving lately is when people try to panic. I said, no, wait, panic on an up day. All right. I'm going to allow you to panic, but you have to call me on an up day to panic. And they go, well, what do you mean? It's never going up again. It's like, once you get to that point, you just believe it's the end of the world as you know it.
Bob, how many update panic calls have you received since giving that advice?
Well, I've had some update panic calls like get me in with both feet. I just sold my Ferrari. I want to put it in the market. It's like, I think back in the 90s, we would get people taking out equity access loans on top of their mortgage to put it in the market. That's a sign of a top.
And by the way, Bob's the only advisor that has clients that have Ferraris. That's who he rolls with. So we could all be so lucky to have a client base like you, Bob. But look, I actually think it's valid. I think 7,000 is not crazy. I mean, if you look at right now, everything's kind of setting up here, in my opinion, for some big move on the upside. I mean, you still have so much money sitting on cash on the sidelines. I think the crazy thing about this move up recently is retail investors were buying, but institutional investors panicked. They took money out of the market during tariff turmoil. So I have to think at some point that money has to get back in the market, which could be a lot of panic buying because this market's not letting you in now. We're not getting a lot of down days here.
Yeah, because as an individual investor, you can sit on cash if you really want to, but as an institutional investor, you've got investors to speak to. So if you're sitting on cash for too long and the markets are going up, that's obviously you're going to get a lot of calls from clients, and that's where that panic buying goes in. So that's where if they continue to be wrong about this and markets keep going higher, you're going to have to see a lot of that cash, which a lot of that's held by institutions, have to go back into the markets at some point.
And what's going to happen with these algorithms, right? Well, we had, these algorithms that just read headlines. They see a certain word to hit the sell button. Now we have artificial intelligence. How much more volatile do you think the market's going to get, guys?
Well, volatile on the upside or downside, right? We like upside volatility.
I mean, both, right? It's like, they see a trend or, they'll identify a word or whatever. Now, I mean, you got these quants that trade on this, on this information. I mean, I wonder what happens when AI bots start buying and selling on a daily basis.
I mean, we saw that pretty precipitously back in early April, when the sweeping tariffs came out. I mean, how much did the market drop at that point? And how much of that was due to potentially AI?
Yeah, I mean, I don't know if it's all AI or computers, but I mean, you're right. That was a mini bear market in the matter of weeks. And we've already passed that. And we're also, looking at now potentially the other side of it, right? Just like, how quickly can this market melt up? And, I don't know if artificial intelligence is going to take over the markets. I suspect there might be an edge there for a little bit, but at some point it'll go away like everything else, and it won't be an edge anymore. But I'm sure there's a lot of automation now with investing.
Yeah, but I think that adds credence to, having a strategy where you stay long all the time. Because, I mean, trying to time the market, especially if the market's going to move that precipitously in such a short period of time, there's really no benefit to try and time the market, even more so.
Chris, you go back to, and I agree with you, when you have a diversified portfolio, like remember when pipelines were underperforming, and it was only a couple of percent in people's portfolio. But it's like, I want out of those completely. I don't want a dime in those. They're yielding 9%, but I don't want any money in there. Get me completely out. And it turns out that, it outperforms everything over the last 3 years. So it's crazy when it's an all or nothing mentality. And that happens. And I think fear and greed does that to you.
And, speaking of fear and greed, I think right now, if it's interesting, if you look at sentiment indicators, they're still not that bullish, right? You still look at the amount of people that are bearish. Even with the economic data every month coming in strong, right? Where the labor market looks great. We know that wages are growing well over inflation right now. I mean, the list goes on, yet the naysayers are still being naysayers. So I think at some point they're going to pass that Rubicon where they're going to give up on their negative view. That's when the real dumb money comes in and really pushes these markets a lot higher. So again, I really do think your biggest risk here is some sort of big melt up, and maybe we're already starting it.
That's what I think is interesting is the news recently has been really focusing on what we call the soft data. So like consumer sentiment, which is how people feel, CEO sentiment, investor sentiment has been really poor. Like everybody feels like the economy is really bad, like inflation's going to get worse, like we shouldn't be investing. But all the hard data, so actual data that comes out and shows, are people still spending? Is the economy growing? How is the labor market doing? All of that has been nothing but positive. And none of that has translated. And what I think is interesting is the consumer sentiment data was just the second worst to spend in history. And you would think the first worst is like, I don't know, 2008, 2009, maybe like a bad bear market.
Right. Yeah.
It wasn't. It was back in 2022 when inflation was running at 9%. And that never turned into this self-fulfilling prophecy where people stopped spending because they were so worried about things. We actually got past that. So I think that's why you don't always want to listen to just how people feel, because it doesn't always mean things are going to go there.
Yeah, Bob, it's almost like don't listen to what I say, look at what I do. And I think that's probably the perfect example when it comes to the consumer.
Well, I think the thing is, Mr. Market's so much smarter than everybody. Everything's all priced in, and we're all trying to sit around and gain this and, be masters of the universe. But the market is simply smarter than everybody. And, you guys keep talking about, people that, say, oh, well, I'll know when to get back in, or, I want to get out. And when I feel better about it, or when you sense it's going to get better. But just look at the experts, right? We came to this year, 6,500, the S&P. No way. That's absolutely where we're going. Market corrects. Oh, I changed my target to 6,000. Now we're 6,000. They're back to 6,500, right? Suddenly, the poly market tells you there's 65% chance of recession. I looked the other day. Now it's 27%. So, the market makes the news. The news doesn't make the market. And I think if you challenge that, you challenge that at your own financial peril.
Yeah, like during in the beginning of April when the market really pulled back, I kind of got the same vibes I got during the pandemic that, everybody was getting out at the same time. The news got a little bit worse, but the market got better before the news got better. Same thing happened in the during the pandemic in 2020, and it just seems like that's sort of a repeating pattern.
Yeah, and I think there's always the market's trade between expectations and reality, right? And expectations, let's face it, they've been extremely low. In fact, now you start looking at earnings estimates; they've come down a lot over the quarter. So all those expectations have really been on the dour side. And what happens when the real data comes in, reality comes in, it's always much better than expected. And I suspect you're going to see more of that right now because, again, it's not like the world, people are looking at the world very rosy. Maybe we are. But I would say most people or most strategists, most investors still don't have those rosy colored sunglasses on.
You're starting to see some of that. Like some of these surveys are, I don't want to say they're improving, but they're getting like less bad. People are getting a little less bearish. I wouldn't say people are optimistic, yes, but maybe we're starting to see that inflection point. I don't know if we're there yet, but they're looking a little better, if nothing else.
Well, we also have the political influence, right? When Joe Biden was president last year, every Republican told me that the market was horrible, the economy's terrible, it's the end of the world. And now then you have the opposite, right? Now you have Trump. You have people who don't like Trump who are rooting for the market to crash. So, or they just, whatever the news is, they want to spin it negatively. So it's, it's always dangerous, as we always say, to view your investments, through your political eyeglasses. You want to take those off and put your politics aside because it can really harm, your success as an investor.
Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. It's the tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And guys, I was reading Barron's this weekend. I know what you're thinking. You read, Ryan?
I didn't actually know you could read.
Actually, I saw the pictures. I actually didn't read the article. But it did talk about the 3 biggest mistakes you can make in retirement right now. And I thought these were great points. I thought we could discuss them on the podcast today. And I think the one that we're seeing a lot right now is when you have a lot of volatility and you have a lot of uncertainty, is this a feeling that you have to do something. And I think one of the bigger mistakes that investors can make right now is making too many decisions with their portfolio because they feel like they have to do something.
Well, I'll tell you who learned that lesson in a big way was back in the late 90s. We had the day traders. Time Magazine had day traders on their cover, right? Doctors, lawyers, corporate executives quitting their job because it was so easy to make money in the stock market. And they all lost everything, not just a little bit. They wiped themselves out simply because they overtraded their accounts.
Yeah, and I think right now it's almost like my neighbor's making money in this, making money in that. You know, it's kind of like the cocktail party talk. And I know, Court, you see this with your clients right now too. It's like, maybe shouldn't we be trying out some of these other investments over here and seeing people getting, maybe lured into some of these more exotic type of investments on Wall Street that they never asked about before.
Yeah, you get these all the time. Throughout the years, they change of like what it is that people are getting pitched. But especially right now, when people look at their safety money and they're saying, okay, I can get 4% on a money market or maybe 4 to 5% on a bond, which is actually much better rates than we've been getting in the last decade. But people are still saying, that's not that great. But then they get dangled with these other opportunities over here that have like higher yields. They call them high yield bonds, which are just junk bonds. There's these like private credit strategies, but they're saying, oh, but look at all these great returns that I can get over here. But usually there's a reason that those higher returns are attached to them. And usually there's more risk. And that's really what you want to look at is they're always going to sell you the next big thing. And it's always going to look more attractive than what's out there. But there's a reason.
Yeah, well, it's like, and nobody really thinks like, oh, this great investment for the big clients, well, why are they offering it to me? No one seems to question that.
Meanwhile, the headlines every day in the news is how every college endowment, every big institution is trying to offload this private credit. It's like they're like begging them to take it off their hands because they realize that they haven't made any money in the last couple of years and they're totally illiquid. And, and they're not able to cash in on these great returns because they're no longer there.
And where are they going to dump those investments? On you, the retail investor, right? That's the way it always works.
And isn't it amazing that, and they refer to the retail investor as the dumb money? Listen, everybody listen to us right now. Wall Street calls you the dumb money. That's us, right? And we're outperforming them all this year.
What's remarkable about it is you think we've learned our lesson, right? This is a lot like the subprime mortgages that we saw, back mortgages back in 2007, 2008. And we're seeing all the same type of investments come up again. It's like people completely forgot what happened in the past and are doomed to make the same mistakes again. We say on Wall Street, it's a very short-term memory, kind of like the weather. And I think that's what you're seeing right now is the animal spirits are out and people are willing to take more risk in more, we'll call them complex products.
Court, you and I were talking about this the other day and you're like, well, if I can borrow, and I'm an individual and I can borrow cheaper than these companies, it just tells you how much risk they are. They have to take so much risk to borrow money. Why would anybody want their money there?
Right. And I think that's the trouble right now is people do watch the news. And especially over the last several years, the S&P 500, which is what the news is always referencing when you hear the markets are up or the markets are down, it's really been outperforming a diversified portfolio, right? And it's because those big technology companies have been the name of the game. That's where all the growth has been coming from. So anytime you compare that to a diversified portfolio, it's been kind of lackluster the last several years. There's actually been a lot of talk about how people look at it as more of like a performance detractor than actually like a risk adjuster.
Yeah, exactly.
Even though you go back decades and decades and the 60-40 portfolio holds up over time, but everyone is suddenly saying, does the 60-40 even work anymore? Maybe we should throw that out the window. And that's really starting to become a question now.
Well, and we've lived it, right? Literally, if you look at after the great financial crisis, for a decade, it was called that most hated bull market of all time because it was so hard to keep people invested. They were so skittish. Any kind of sell you had in the market, they wanted to panic out. And if you look at that 10 years or so, markets basically went straight up. and the risk was very low. Valuations were very low. Now you're at a point where valuations are historically high. Everybody wants to get in at the same time. It's really been since the pandemic. The animal spirits are out, and it's just like retail investors tend to do that, right? They want to put most of the money in when the risk is high, and they don't want their money in when the risk is low. And this is like why we have a job, because invariably people want to make bad decisions.
Yeah, the other thing too, I think, is really a salient point here is the fact that a lot of investors lose sight of the bigger picture, right? Like they might have, a 401k from a job from 10 years ago that they forgot about, or a lot of times a client will call and say, well, look, I keep money over at Schwab because I think that's going to be more diversified. It's going to be safer. But what you end up finding out is that portfolio is completely opposite of what we're doing for them. So there's no concentrated effort.
There's no concerted effort. And we saw this court on a case recently where this person had 2 different advisors and 12 of the funds invested all in the same thing. So the advisors weren't talking to each other and everything was concentrated in one area.
And we find that pretty often. And you have a bunch of different funds. They all sound like these fancy funds. They all sound a little different. One is like a growth strategy. One is like, your long-term strategic allocation, whatever it is. They all just own the S&P 500. They all own Apple and Google and Microsoft, NVIDIA. And the problem is it's great. Those things are doing well. And people tend to look at your past performance, but you also need to say, okay, if I back tested this to how the markets did in like a 2008 scenario, God forbid that happens again, you want to make sure you know what your downside is. And a lot of people don't realize that when you have all this over concentration, your downside risk is a lot higher.
Well, I think too, and this is why I think it's really important to run a financial plan, is that I think a lot of times people just forget about things. They forget about an account. And, when you go through and you're like, oh, I had this 401k or I have this IRA, like you can actually go through and say, okay, we've got a concerted goal here. We know where we're going. And then they find all these accounts that they didn't realize that they had.
It's so true, Chris. I mean, people just, look, life keeps you busy, right? You're focused on your family, on your career, on your lifestyle. The last thing that really gets focused on are people's finances. So, once things are in a spot, they think it's better to keep it there than to change it because it takes too much time and energy.
Yeah, and the great irony is a lot of times we put accounts at lots of different places because we think we're diversifying, but then we find out that, well, at all these different places, your money looks pretty much the same. And I think that's probably one of the best risk management tools is to understand what you own, where it's owned, and how it all works together, doesn't work together. And I think that's the exercise everyone needs to do, especially when you're thinking about retiring and drawing from your portfolio. Because I think a lot of people are going to be surprised they're taking way more risk than they thought they were taking. And that's what that exercise basically tells you.
Well, how many times have we seen investors, as soon as you get a downturn in the market, they stop contributing to their 401k. They stop opening their statements, right? It's, it's an emotional reaction and a learned behavior that is really hard people. But you know what? Things may be changing, right? We went through the Great Depression. My parents saw the Great Depression, your grandparents, and they were scarred by that. Now you have, I see with a lot of baby boomers, they've made so much money in this big boom and bull market that we've been in for the last 50 years that they don't see the downside anymore. Like every dip's an opportunity. And that could be a little scary, right? It could lead to a huge, gigantic melt up like we've been predicting. But I'm wondering at what point people are going to get too greedy and too aggressive.
All right, it's the hidden facts of finance. Random financial facts that may surprise you or even shock you. All right, Bob. As of March 31st, Bridgewater All-Weather ETF, this is an actual ETF by Ray Dalio, held 76% of its assets in U.S. and foreign government bonds, 42% in stocks, 39% in commodities, and 30% in inflation-linked treasuries, a leveraged 187% exposure. Yes, they're using leverage. So you would think with all this knowledge and know-how that they would be getting higher returns with all the sophistication. But believe it or not, from April 2nd through April 8th, when the Vanguard Balance Index, which is a very simple fund, lost 8%, well, guess what? So did Ray Dalio's fund, even with all sophisticated commodities and leverage and derivatives. So I wonder, this quote-unquote all-weather fund, Bob, maybe it's not better than just an old-school Vanguard balance fund.
Well, it's a lot better for Ray Dalio and his company because if you use leverage, that means the fees are higher. But whenever you use leverage, the returns are going to exacerbate on the upside and the downside. But, let's face it, Net of fees, Ray Dalio hasn't made anybody any money they couldn't have made on their own.
Well, we've been calling for apocalypse now for like a decade and a half. That's what drives me crazy. And he hasn't been right. But they always come out every couple of months and say Ray Dalio sees a big economic collapse coming, and it never does.
Well, it's like all these strategists that were negative, when interest rates went up a couple of years ago, when oil went to $120 a barrel, they kept calling for the no-show recession. And then the market hits all-time record highs last December. Now we're getting close to new highs. They say, well, yeah, I was bearish, but I was fully invested.
I'm not sure on the ETF, but I mean, yeah. So the hedge fund, I think after fees, it barely beat the S&P 500 since inception. So
that was most hedge funds, yeah.
And he wrote a really boring book, by the way, that everyone's lauding, but you read it, you're like, man, this is really boring.
Kind of weird, actually. I thought some of the practices.
People ought to wear like signs on their head or something, so you know what their personality traits are. Autistic hedge fund manager runs a company. That should have been the book title. I digress. All right, Chris, from 2005 through 2024, 7 of the S&P 500's 10 best days occurred within 2 weeks of the 10 worst days, according to JP Morgan Asset Management. It's treacherous to sell when markets are down and volatile.
Well, it just goes to show you really can't time the markets. And my favorite phone call that I always get is that when markets are tanking, people are like, well, let's get out. And then when you sense the market's going to go back up, let's get right back in. But, the reality is it doesn't happen. Markets move up pretty fast, and it's really impossible to time.
I thought I was paying you to sense the market's going to go back up. I'm really disappointed. You couldn't just figure out that magic day, Chris?
Well, you know what? I called Ray Dalio and tried to get his advice, but he wasn't much help.
All right, Courtney. According to Truvieta, a health data company, Wegovy prescriptions surged by 50% in teens in 2024. The drug was prescribed to 14.8 of every 100,000 teenagers. Of course, that's a drug by Novo Nordisk, is the company that makes Wegovy and Ozempic, a Danish pharmaceutical company.
It's amazing how widespread this is. And you're seeing this just with all of the demand that's going in there. So you're seeing not just Novo Nordisk, but Eli Lilly. They're the biggest manufacturers in these weight loss drugs. And you're seeing this actually affecting a lot of other areas of the country. So even today, for example, there was a downgrade on McDonald's stock because of the Ozempic effect of people not wanting to eat it any longer, which is pretty fascinating. They're saying it's going to make people have to buy more clothes because they're losing weight. Even in the alcohol industry, they talk a lot about how younger people aren't buying alcohol as much. Part of that also is people who are on Ozempic don't want to buy or don't want to drink as much alcohol. So this has like a huge effect on the overall economy, which is pretty interesting. I think we're just in the early innings to see what the ripple effect really is.
Hope you enjoyed this episode of Payne Points of Wealth. If you like our podcast, you love our podcast, please give us a support. Give us a 5-star ratings on iTunes, on Spotify. Share this podcast when you could benefit. And if this is on YouTube right now, you can like this episode, subscribe to the channel, click that notification bell. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.